And with this American Equity Income Shield product, which is their flagship income product, we'll notice a few things. Obviously we have it to where it's going to compute the guaranteed annual income. If we want to see that monthly, we can just hit a toggle button here and look at it from a monthly perspective. But really what goes into the income is the roll-up rate, which in this case, it has a simple interest roll-up rate of 8.25%. And then we'll notice how over the 5-year period, assuming they put $100,000 into this vehicle, we'll see what that income benefit base amount calculates to then determine what that income amount is going to be on a guaranteed basis. Now, what I will tell you, and I've said this in previous episodes, is don't just get caught up in the income roll-up rates. Like, none of that really matters. If you're really just trying to shop the marketplace on who's going to give you the highest roll-up rate, you're not always going to find the highest contractually guaranteed income, because there's multiple parts or elements that go into the formula, or factors, I should say, that go into the formula. It's income benefit base multiplied by the contractual payout percentage, which is determined based upon the age of the younger of the two annuitants. So these are contractual payout rates. So in your contract, when you get this annuity issued, it's going to have a payout schedule. And it's going to say, if you activate the income at this age, here's what the payout percentage is. So you take that, whatever that payout percentage is, multiplied by the income benefit value, and that's what will equal the annual figure, which we're now looking at monthly. But if you're just shopping roll-up rates, you're not going to find the best deal. You have to go by what's the contractually guaranteed income amount, and that's factoring in the benefit value and the payout percentage. Sometimes what we find, and maybe we'll do this later on in this episode, is you can find a really competitive roll-up rate, which will juice up the income benefit value. But what they'll do is they'll lower this payout percentage in the contract. So either way you slice and dice it, it's still a lower amount of guaranteed income.
Yeah, and that's really why we're trying to drive home the point of not getting caught up in, using the analogy, how the sausage is made, but the end result of how we got there.
Yeah. So what we're going to end up doing in this episode is we're going to really start to look at these evaluation points in the multi-point inspection. And then at the end, we're going to show you how we open up the entire marketplace to then start to compare all of them. And we'll see where that American Equity ends up ranking according to maybe some of the other options that might be available once we take off that filter. But we want to use one product for now, just to kind of give your eyes a centralized focal point so that you can start to follow along and how to look at these.
Yep. Yeah, great point. So we're covering highest income guarantee. I think you had covered that while I was gone. So if we move on to the next point in that, using that 5 critical areas of what we're searching for in the multi-point annuity inspection, that would then be the carrier rating. So on that carrier rating, this is really where we're checking the insurance company's financial strength. And from our end of it, we can get a quick snapshot of what that letter rating is from that carrier. And really what we're looking for, as Jeremiah is displaying now, is multiple sources of ratings. Here you're seeing a rating from AM Best, Fitch, S&P, and Comdex. So we're really looking for a broad overview of multiple ratings that we can use as a source. I will say that we typically like to go a little bit deeper into that. Maybe you can elaborate more.
Yeah. So in addition to the letter rating, according to whatever agency you might be referring to, we also like to look at other areas of evaluation. One of those being, the balance sheets or the financial overviews of these companies. And that is kind of what the agencies are looking at anyways, but it's really good to compare one company to the next, because you might have a company that is an A rating and the next company is also an A rating. And so you're thinking everything's apples to apples there. But what we find is that that's not always the case. When you start to uncover their financials, you might learn that one A rating company might be significantly smaller from just the sheer size of assets under management versus the next A-rated company. And sometimes bigger can mean better. It doesn't always mean that, but I know for me, if we're thinking about a 20 to 30 year window of income guarantee that we hope this contract will continue to pay out for, your guarantee is only as good as the issuing insurance company and its claims paying ability.